Well, good evening and welcome to a brand new show of GST and markets. A big day for the markets, not in terms of price action or not in terms of price movement. It was a big day because today there was a mood of relief, some degree of celebration, and a big day when it comes to the positioning of India, which changed in eye of global fund managers. GST is now a reality, and markets were very sharp in realizing that. We saw a GST adjustment in some of the key stocks, whereas for the broader market it turned out to be a day of buy on rumors and sell on news. But net markets, after a volatile start, recovered from the day's low.
Oh yes, indeed. It was, I think, a decent day one, adjusting to the reality of GST becoming the key reform that the markets and the economy watchers have been waiting out for with bated breath for the longest time. And so we make sense of what it would mean in terms of market trend going forward from here. Has the market completely priced in the GST news, or is there more to go? Perhaps a dash for all-time high levels on the index. In lieu of this big announcement, this big reform going through. Power pack lineup of guests over the course of the next 30 minutes. And we have Nirmal Jain of India talking to us about his sense of the market trend from here in lieu of these key reforms being passed, GST, bankruptcy code included. Dharmesh Mehta also talks about how FIRs are feeling about India amongst emerging markets. Gautam Chhaocharia does the same. Manish Chokhani gives us his perspective for this key policy announcement. And Ajay Bagga also outlines how it brings out some key investment opportunities for viewers to benefit from in the near term.
Right, so let me kickstart the discussion, and let me kickstart that with Ajay Bagga. Ajay, it's an important day. It's an important day, not from an price point, or not from and not really from the price action we saw, but it's an important day because now GST is a reality, and at least somewhere it is a moment we've been waiting for.
Yeah, definitely, Nikunj. I think a couple of things. One, market is not everything for the economy, for the industry, and even for the consumption classes of India. It's a very seminal reform. It's a huge reform, creates a common market. I run a very small company, and we have 29 offices where we have to do VAT administration across 29 states, apply for VAT input credits, look at it over multiple years, and continuously the policies at state levels keep changing, where it makes it very difficult to do business in India. So something like this is very welcome. It will be a painful process. It is a complex process. It's not going to be one magic wand which comes in and life changes. There will be a lot of pain in the transition for the next 2 years, and there will be a lot of disputes also which will arise. But overall, it's a huge reform. Has the market missed it? I don't think so. I think market, as always, being the wisest, they have seen it earlier, and they have discounted it much earlier than anybody else, and that's why we saw a tepid response both yesterday and today in terms of price. But it changes life very significantly for all the productive sectors of India, so most welcome.
All right, and this comes at a time when we're also going to be looking at the RBI announcing a new RBI governor shortly. Of course, we're going to be looking at the credit policy, giving out the policy stance on rates, where globally we are in a scenario where rates are going down, and that is pretty much the expected course of action that the domestic central bank might also take going ahead. In fact, the Bank of England has also cut rates by 25 basis points, and that was pretty much an expected line. So you're looking at a low interest rate, accommodative policy stance, not just in India, across the globe, and that will also fuel sentiment in addition to what we are seeing. So we have the reforms in place, and now it's just the central bank support and their commitment to be accommodative that will help the markets.
Well, BOJ has moved, and Bank of England was supposed to move. I mean, it's just that they moved 1 month after the Brexit. Ideally, they should have moved immediately after the Brexit. But again, most of the central banks are just following the same policy, which is that keep the interest rates low, print more money, and try and bring back inflation, which is not happening. So they are they're desperate right now, and somehow I get a sense that most of the central banks are now running out of options. Apart from just throwing money, the concept of helicopter money, they're doing everything they can do.
Yeah, and Nikunj, even during the Brexit time, everybody was talking about how rates in UK are going to go down to zero. So 25 basis points now, 25 basis points to go. But either way, the cost of capital globally is low. It's cheap. I mean, India has one of the highest rates when you compare to global peers and emerging market peers. We were talking about how in Australia, record rates are at record lows of about 1.5%. You've spoken about Bank of Japan. Now there's the policy of negative interest rates. So really cutting rates is not the solution, and I think that's been accepted. Maybe this boosts sentiment in some way, that the Bank of England is giving out their commitment to the economy that, look, we're going to be supportive of whatever happens going forward, whether it's liquidity measures, whether it's rates, we're going to keep the policy stance accommodated. And I think that's the only message or signal that's going out. But it doesn't really change meaningfully in any manner the fallout or the implications that come in from the Brexit vote for the UK.
And a classic example here is BOG, and negative interest rates are not helping the European Union as well. And Ajay, whereas we can talk about the loose monetary policy central banks are following, Ajay, but let's be real, the cost of capital is coming down, and typically when we are in a world of negative interest rates, the only asset class we could go to is perhaps equities.
Yeah, absolutely. This will engender more inflows into the risk assets. What you are flashing right now on the screen, Nikunj, more corporate bond buying or getting into corporate bonds, just like the ECB has been doing, the Fed has been doing for a long time, and expanding the QE also by another 60 billion pounds. So overall, lot of money being put in by all the central banks. Again, markets have more or less discounted it. In the last week of June itself, the markets recovered very strongly from the Brexit fall on the back of expectation of strong convergent central bank action from all over the world. I think that is now playing out. US Fed rate hike, I think that goes at least to middle of 2017. If at all, in this kind of a scenario, it will be very difficult for the Fed to hike rates, nor is the US economy recovering so sharply that they can really justify. So I think the slight chance that was there that a September or a December Fed hike, I think that goes out of the door, and this moves earliest to next July is what I would think, if at all. July is a very far away, 12 months still to go, very difficult to really prognosticate. But overall, risk on rally continues, and it's positive for the emerging markets, positive for us, enough and more news flow around how the ETFs are bringing in flows to India. I think more flows come in. Already $13 trillion of money lying which is earning negative rates. That will look for some kind of returns. Gold moves up, emerging markets move up. I think those two signals are very clear with this. But has it been discounted? I think to a large extent markets have already discounted this action of Bank of England today.
Ajay, it's a bizarre kind of an global screen, Ajay. And when I say bizarre, I'm using my words very carefully. Let me just outline the headline mood. The headline mood is bond markets are pricing in a Greece-like situation. Equity markets are sitting at a record high, and gold markets are telling me that a risk is round the corner. So should I look at the gold market and protect my capital? Should I worry about the declining bond rates which are indicating a recession, or should I talk about S&P which is pointing to a new growth cycle?
Very tough, and I think nobody has an answer. What the market is getting, a little bit, you can say laid back, that whenever there is trouble, the central banks will step in. And as you mentioned earlier, the ability and the productivity of central bank intervention is reducing very sharply. We've seen that in China. We saw that in Japan, that when they announced negative rates, actually the yen strengthened further. And the productivity and the ability of the central banks to push the levers is reducing. To be fair to them, they have been talking about it. They are saying the governments need to step in with fiscal reforms, with fiscal stimulus, as well as structural reforms. That is been the common theme by central bankers. But the politicians have to survive, they have to win elections, unlike central bankers who just lose their jobs and go away. So overall, I think monetary stimulus has reached a point we have never seen in history. The productivity of monetary stimulus is reducing. So we are on uncharted territory. I would not be complacent at all in such a market. You need to stay very flexible, very nimble-footed, because this can change. Right now, it's complacent markets on the back of very huge liquidity unleashed by central bankers in a convergent manner. Unlike 2008 also, there were sounds, and even the ECB was a hawk in 2008. They did not follow immediately. Today, all central banks are more or less on the same page, and Fed will probably be kicking itself for having raised the rate in December. They stick out like a sore thumb as the only developed market central bank which has raised rates in the last 6 months.
Right. Yeah, and I think that's going to be a slow and shallow cycle for the Fed as well in terms of the rate cycle that they'll follow from here. But Yan then joins in with a quick perspective on this BOE decision, as does Nick Parsons. Yan, this is, like Ajay pointed out, yes, so they have cut rates by 25 basis points. Yes, they've expanded the QE program, but the productivity of additional QE has to be measured, and really, from the market's point of view, it means diminishing returns because the markets are getting used to this drug over the last 8 years.
Yeah, absolutely. And there's no doubt that Britain is going to need more stimulus. As your previous speaker was suggesting, the underlying problems have more to do with debt and productivity. But because of the short-term incentives facing politicians, nobody really wants to deal with that. So there's been this exaggerated emphasis initially on fiscal stimulus, then to monetary stimulus, and now we are really, as you point out, going into diminishing returns to monetary stimulus. The Bank of England is now buying corporate bonds, but we know that 15% of European corporate bonds already trade with negative yield, which is clearly evidence of a bubble in credit markets. So the implication of this is that as Britain needs even more stimulus, because Brexit is a really bad thing for the British economy, then we should expect a rotation into fiscal policy. But the rotation into fiscal policy is challenging because, according to the IMF World Economic Outlook that was released back in April, the average debt stock in advanced economies is this year expected to be 107%, which is actually higher than during the European debt crisis back in 2012 when it was around 106%. So the room for doing further fiscal policy here, i.e. more debt issuance, is also questionable. And the really big implication of all of this, really, for investors is get out of these QE economies. There is another universe out there where countries are reforming, where yields are higher, where nobody's doing QE, where there is growth. India is one of them. These are obvious destinations where investors should start parking their money and take profits from the monetary-sponsored developed markets where returns have been good for the last few years, but the outlook from here, frankly, is not very exciting.
Very important point, Yan, that you've raised is get away from the QE economies and get into markets where there's growth or there is an opportunity of yield on a relative basis. And, I completely get it. It's really emerging markets. And within that, if you profile each of the emerging markets at various levels, political stability, management of debt, growth prospects, India really has a lot going for itself right now. Nick Parsons, would you agree with that? This is going to really fuel the emerging market rally for the second half of the year, and India more so within that pack?
Well, I think every little helps, as the phrase is. I disagree with most of what your previous speaker said about the problems of debt. If there was a problem of debt when it's exceeded 106% of GDP, then surely it would have shown up in capital flight from bond markets. The very fact that bond market yields are negative shows that investors are very, very willing to finance new levels of government spending, and that's precisely what should be taking place right now. If monetary policy has reached its limits, then there is plenty of room for fiscal policy to take up the slack. The reason that fiscal policy was a problem in 2012 was because there were concerns about the sustainability of the debt trajectory given the level of interest rates. Well, of course, if you slash the level of interest rates to zero, then those debt levels are infinitely sustainable. So I don't see there being a problem with an expansion of fiscal policy, although I do accept that monetary policy and QE expansion is at the margin a positive for EM, yes.
Nick, I have a very basic question. Now, the fact that banks are following or central banks are following a loose monetary policy, that's not new. I mean, this has been the stated monetary intent for a couple of years now. Now, despite the money printing brigade which central bankers have been on, emerging markets in the last 5 years actually have underperformed.
Well, yes, they've underperformed because there have been significant concerns about the rate of growth in the largest of the EM universes, that's to say, in the Chinese economy. And I think it will take some time for those concerns to diminish and abate, and therefore some time to get onto a path of growth whereby the EM can sustainably outperform over time. But selectively, I see no reason why EM resilience can't continue to be demonstrated, and at the very least they ought to keep pace with developments in developed markets. So I think really it helps the resilience. It will help at the margin with outperformance, even though as yet, as you rightly say, it's not yet come through on a sustainable basis, because of course we've had such a drag on the universe from sentiment around China.
Okay. Jan, comment on that even though money printing has been a constant feature for last couple of years now, nearly half a decade, yet emerging markets as an asset class, they have underperformed, and B, there is still a lot of global liquidity which is sitting in bonds or which is sitting in instruments which frankly don't offer a yield.
Can I come back on some of those points? This is Jan from London.
Yes, please.
Okay, I just wanted to point out a few things. At the moment, 15% of all outstanding bonds, corporate and sovereign, in developed markets have been bought through QE programs. And in addition to that, you have had very significant financial repression through changes in regulatory regimes for insurance companies and pension funds, which has forced many of these institutions to go and buy developed market bonds. 70% of government bonds in developed markets now pay negative yield. And even the really long-dated bonds, for example, long-dated German and Japanese bonds, if you have a move in interest rates of the shift in the yield curve of just 100, 150 basis points, which is something that happens as recently, for example, as 2013, then you're wiping out up to 67 years of carry. This is not a particularly good risk-reward proposition. In addition to that, I would just point out that the average bond yield in emerging markets, as recently as February of this year, across corporate, sovereign, local, and hard currency debt, was higher than when the Fed had interest rates above 5 3/8% back at the end of 2006, before the global financial crisis. And this year is the first year since 2011 where the EM growth premium is picking up. So you're getting better growth. EM has survived an onset of external shocks, strong dollar, falling commodity prices, taper tantrum, and so on, with very low default rates. So we're going into a cycle here where economic growth, the growth premium in particular in emerging markets, is going to be picking up. And that's just not just my view. This is also embedded firmly in most people's forecasts, while at the same time you're being paid yields that are very, very close to levels that they were when the Fed had interest rates above 5%. This is a much, much, much better relative value proposition than piling into developed markets. And I'm worried that if developed markets should embark upon a major bout of fiscal stimulus, then I think that unless they engage in much further financial repression, I think they're going to really struggle to place all these bonds at these very low yields. And that means that the only way they can place those additional bonds is through further financial repression, or, of course, if their central banks buy them through helicopter money.
Right,
and
we can
that
look at it.
is not good for inflation and currencies.
I agree. Yeah, and we can look at it whichever way one wants to build the argument. But I just want to bring your perspective, both you as well as Nick, on one aspect on, does this support from the central bank in the UK make you more bearish about the situation within the region and the fallout of the Brexit vote in Europe? Because now we're talking about the possibility, or at least there is speculation about Italian banks falling out and that bringing about a contagion in the banking sector in Europe. U.S. growth for the last quarter reported growth came in much lower than estimates. So there's worry about sustainability there as well. Yes, this is painting a stronger picture for emerging markets, but it's really a high correlation environment globally when it comes to markets. So don't you think that if the developed world feels a sense of weakness, then that will spill over for EMs too, and perhaps that will just increase the attractiveness of safe haven trades? Nick, come to you.
Perhaps I could just say a word about Brexit and the impact on Europe, because I'm firmly of the view that the Brexit vote in the UK is a positive for the European economy. And I can't for a moment imagine that the EU would have considered a bailout for the Italian banking system had the UK voted to remain. As it is, the UK has voted to leave the EU. It shows the fault lines within the monetary union. And the Italian Prime Minister Renzi has played the game exceptionally well, where merely he argues that if the EU will not allow a creative bailout whereby state funds can be injected into the banking system, he will merely offer a referendum in Italy. So I think that the Brexit vote in the UK is a game changer for the European economy, and I believe that Europe will emerge stronger as a result.
Okay, I'm going to get closing comments from Ajay Bagga as well. And Ajay, with all the money printing which is going on, I would like to remind everyone that let's not worry about inflation or let's not worry about global growth. Let's worry about what Italy will do in the month of October.
Yeah, overall, I think it's positive for the Indian markets. We are seeing strong inflows coming in. And, that's what we are looking at. Very interesting here, to hear Nick's views. I differ from them, but, you're allowed to have different views, and that's why there is a market. But net, India is a beneficiary. India is in a good spot, showing good growth, and it's not a commodity producer. It's rather a commodity consumer. So even that macro trend works for us. But overall, there is a global oversupply, there is excess capacity in the world, there are structural imbalances, which none of these monetary policies, they are just papering over the cracks. And I would say that this was the time to take some strong action. The political will always be lacking because they have to get re-elected. The central banks have to step up and take some of the better decisions which are not getting taken. We are just kicking the can down the road, and then when it comes home to roost, it comes home as a much bigger bubble. That is the unfortunate part. But right now India is a beneficiary, and our markets will benefit from this even more injection of liquidity into the global markets.
Right. Gentlemen, thanks very much for taking out the time to speak with us today. Jan, Nick, Ajay, thanks very much for putting this news piece in perspective. You can see how the immediate reaction from the equity markets is one of excitement. The CAC, DAX, FTSE all up 1% plus in reaction to the Bank of England's announcement to cut rates by 25 basis points to 25 basis points. Now remember, there is expectation that rates will go over the course of the next 6 months to zero. It's expected. it will happen. The Bank of England has already, conveyed that intent. They have said on account of the Brexit vote fallout that they would support the UK economy as much as possible, but it's really not about cost of capital as much as it is about bringing in a good relationship with the European Union as they break away from the trading bloc over the course of the next 6 months. So that's going to be key. But expect more such announcements from the central bank in the United Kingdom, cutting rates as well as perhaps extending out more QE for a longer period of time and expanding it as well.
Well, that's the big story. Thank you for watching the show, and we'll stay with the breaking news. Bank of England has cut interest rates after a gap of nearly 7 years.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.